Hey everyone, it's Paul with Investment Tuesday, and today we have a jam-packed Investment Tuesday focusing on the massive, absolute, huge bubble that is going on from AI to tech to the S&P 500, Nasdaq 100. I'm going to tell you why this is a bubble, my judgment, my opinion, what pricks these bubbles, then how I believe this plays out, and how in that how you'd want to set yourself up for it. Checking my notes because there's a lot going on here, right? And then like some obvious questions that people are going to ask, when somebody presents something like this. But let us first get to all of the legal disclaimers and disclosures, which is that this video and all of the content on this YouTube channel from Mampilly Research is not investment or financial advice. It is presented to you as opinion, information, and engagement and entertainment only. Past performance does not reflect future results. Whatever you choose to do with our content, it's your responsibility because it's your money. All Mampilly Research content may contain errors, oversights, and mistakes. Understand that investment operations have significant risks and can lead to the loss of your principal, meaning you lose money. I, the owners, employees, contractors of Mampilly Research, we own, trade, transact in the securities I mentioned in this video and all content from Mampilly Research. We don't take money from anybody to recommend stocks or any kind of investments. We're independent. And then if you are interested in subscriptions, well, go to mampillyresearch.com. All right. With that, let's get going on what I think is the most important thing right now, right? I mean, I always try to approach this with like, hey, if I was on the other side, what would I want to know? Maybe it's not necessarily what you want to hear, but what would, I want to know, right? And from my perspective, the biggest thing, and I've been posting on X regularly, those of you who are subscribers, members of Mampilly Research, I've been saying this, which is like, this is a time to be careful, thoughtful, cautious about your risk exposures. Why? Well, because in my judgment, risks are elevated and very high. So the number one reason for that is this enormous AI bubble that has just grown and grown and grown. And now it has taken on a size and a proportion that is like mind-blowing and record-breaking. So let's go through some of the both mind-blowing and record-breaking parts of all of this, all right? So I have been posting on X. The bubble in semiconductor stocks is driven by huge speculative fervor, concentration, leverage, all in one. So I found this DRAM ETF, right? And this thing was launched on April 1st and has $10 billion in assets. Maybe that doesn't seem like a big deal, but you'll have to take my word for it. That's a big deal. And just for context, it is the fastest growing, asset, in an ETF in terms of a launch from 0 to 10 billion. It's the fastest. So to do it in a month, yeah, that's absolutely nuts and ridiculous. And it reflects the insane, bubble mania that is ongoing for everything and anything that is AI. I looked this up. There are 2 leveraged ETFs on semis. And I really want to say, like, listen, I am not telling you to go buy these things, right? There are many people who's like, oh, wow, that looks really interesting. Well, if you do that and you get crushed, that's on you. I'm really presenting these as like, hey, these are warning signs. These are not good things, right? Just to make it clear. All right, 2 leveraged ETFs on semis. This have $20 billion in it, right? And then there are lots and lots of like single stock ETF, leveraged ETFs on mega cap stocks like NVIDIA and others. Bottom line, there is a serious major bubble in this sector. And like all parties, it's fun while it lasts, but when the pain comes, it's painful. So let's go to, my second concern here, which is that this AI, bubble, has now reached such proportions that it is now infected the entire US stock market as represented by the S&P 500. So the S&P 500 now is comprised 23% of chip companies. 23%. And look at this chart, right? I mean, this is at near, like, this is after the dot-com bubble crashed. We're at near zero. And then, for a long time, we're under 5%. We are now at over 23%. Yes, there are people who justify this. There are people who say, well, Paul, the earnings are going up and it's all justified, and AI is going to be so big, it is going to happen so fast, and it is going to continuously create wealth in such a magnitude that this can all be justified. Having been in markets for 30 years, just count me in the skeptical camp on this one. But nonetheless, as a regular investor, you have your money in the S&P 500, 23% are in stocks where, I was telling you, you've got, insane speculation going on, leverage, in those ETFs, people chasing after these sectors, never a good thing, never a good sign. And it has, essentially gone from AI to everything chips, everything tech, and essentially everything, in the big indices. Let's go and look at how concentrated the S&P 500, and you can do this for the NASDAQ 100, but I'm just going to do this for the S&P 500, has become, right? I mean, here are the top 10 companies, right? NVIDIA, Apple, Microsoft, Amazon, Alphabet. There's two different stocks of Alphabet. There's Broadcom, Meta, Tesla, Walmart. In the top 10, 9 out of the 10 are tech or tech related in some very direct kind of way. And they've all gotten some amount of participation in this AI mania, AI bubble, right? And so let's just look at what it's done to the S&P 500. The top two companies now represent 15%. So NVIDIA and Apple by themselves are 15% of the S&P 500. It's a 500 stock index, right? You buy it for diversification, but two of them represent 15%. Let's go a little bit further. What about the top 5 companies? Well, you're up to 27%. So again, 500 stocks, but the top 5 is 27%. There's only 73% left to go. Let's do the top 10. The top 10 is nearly 40%. So 10 stocks, 40%. Sorry, yeah. And the remaining 490 is what, like this remaining 6%. Let's do the top 20, and I'll stop there. The top 20 are 50%. So you got 20 companies representing half of this index. The remaining is 480 companies that represent the other 50. This is not really a portfolio. This is a concentrated bet on tech, a concentrated bet on semiconductors. And so you may think this is great. You may think that this is justified. And hey, you're entitled to your point of view. There's no need to come and shout my opinion down if you have a different point of view. My experience, my judgment is that this is a sign of a peak, sign of a top, sign of danger, sign of risk. And I would tell you to, again, be thoughtful, cautious, and careful with your risk exposures, especially as it relates to any of these stocks, generally the S&P 500. You can throw the NASDAQ 100 in there. It looks pretty much the same. And now you can see this on a chart that compares, like, hey, over time, what does concentration look like? And you can see in the 1980s, the peak concentration was about 11%. At the 2000 peak, it was about 9. At the 2007 peak, 7. We are nearly double that here. So lots of historical observations are saying that we are, in and around that territory. All right. So what can prick these bubbles right now? Well, the number one thing that you can see very clearly is the oil price. Oil has gone from about $60 a barrel to about over $100 a barrel, but that doesn't really do justice to what has happened to, if you're like have a car and you need to fill up your tank, if you're buying a plane ticket and you want to go somewhere international, I mean, there the jumps have been 50, 70, 80, even 100%. So why does that matter? I mean, oil prices by themselves wouldn't necessarily do damage to the economy or to people's sentiments, etc. But oil price is obviously a big has a big impact on inflation. But inflation in general across the board, right? I mean, is essentially exploding higher. Just a few days ago, we got the producer price index number. What's the producer price index to start with? Well, the producer price index, as I explain in this post on X, this measures the price increases that companies are passing on to each other. And sooner rather than later, as I may point out, because people are like, well, who cares, Paul, if companies are being charged more money? Well, sooner rather than later, this gets passed on to consumers, or else companies are going to see their profits decline. So they're going to pass this on. So in other words, this is embedding inflation that is going to show up everywhere. The other remarkable thing about this, which is that it looks like inflation is sort of like exploding higher even without oil, because 68% of this producer price index is services, right? Services doesn't have oil in it. In other words, energy prices are embedding itself into all kinds of price increases. So this is something that is big and drives something that the market definitely cares a great deal about, which is interest rates. All right, so I put up this post here talking about the 30-year bond and how it's breaking out to 10-year highs. And in fact, I'm recording this on Tuesday, and it's made actually a 21-year high. The 30-year bond is now closing in on about 5.2%, and that is a big deal. Now, right now, it's getting a little bit of attention, but this chart is a little complicated. But what you have here is you've got short-term rates, which is the red line. You've got purple, which is the 10-year bond, and then you've got the blue line, which is the 30-year bond. The 30-year bond is now the one that is breaking out. And that blue line represents a kind of like, that was the old ceiling, and it's been there essentially for almost 20 years. And it's busting out. Why is it busting out? Well, because of what I laid out earlier about oil prices and inflation. Now, this purple line, that's much more important to the market. And when that starts to bust out past this blue line, you will start to see the market pay attention. Why? Well, because it starts to affect many interest rates that you and I interact with and care about. Number one, mortgage rates paid by home buyers. Mortgage rates are about 1% to 2% more than the 10-year Treasury bond yield. So, yeah, that starts to break out to 20-year highs. It's going to take mortgage rates up with it. Mortgage rates going up, not so good for real estate prices, not so good for real estate transactions, which is not good for the economy. Corporate bond yields, in other words, companies borrowing from the bond market, their costs to borrow are going to go up because corporate bond yields are tied to the 10-year Treasury bonds. And so the price of bonds will go down. The amount of money that people start to borrow will decline. Again, not positive. Municipal bonds, which are, what local and state governments, that's what, they borrow. They're also benchmarked against treasuries. Bank loans, real estate loans also reference the 10-year Treasury. And then it's used in pensions and insurance. And then most importantly of all, especially to this AI trade, right? The idea with AI mania, AI bubble, is that AI is going to make so much money and it's going to happen so quickly, but it's not going to happen, in a second. It's not going to happen in a minute. It's not going to happen in an hour or a day. It's still measured in many years, 5, 7 years. Those will be the biggest payouts, right? Because AI is going to get better, et cetera. So that's why all of these AI stocks, they can, say like, look, in year 7, the revenue is going to be, 30 times where it is today. So of course, these stock prices make sense. Well, all of those stock prices, they have to like hit a certain benchmark. There's a yardstick, right? They got to do better than the 10-year bond. So lower interest rates generally are better. Rising interest rates are generally bad because it means that future money is worth less than current money. So you've got the sort of like the hurdle rate or the benchmark is jumping higher for any investment, any opportunity, any stock where the peak is somewhere out into the future. And people, are being like, well, Paul, 5% is nothing. AI is going to generate, 50% a year. I mean, at the peak and manias and bubbles, people come up with insane ideas. Just for some context, the internet, as widespread as it was from sort of like the 1990s to the 2000s, when its impact peaked, the increase to productivity was somewhere in the range of 3 or 4%. So I mean, AI will likely arrive at something that is similar. Maybe it's 4, maybe it's 5%, but it's not going to be 50%. So the 10-year bond, its yield going higher will matter for all of these AI mania stocks because the value of those discounted cash flows, they go down when interest rates go up. So higher interest rates, not a good thing, not a good thing. All right, I'll just put, all of these things together in this chart here. We've got the consumer price index. So that's, what you and I experience in terms of prices. We've got the producer price index, that's in orange. And then we've got the 30-year rate, which is in lightish blue, and the 10-year bond in green. We're about, all of these going up is a bad thing, period. But these going up, the light blue and the green going up, means that interest rates are going up. And interest rates are to the financial system as gravity is to physics. I mean, you can't escape it. And when interest rates go up, at minimum, it sort of like compresses the value of other financial assets. But when it starts to go up where, you're starting to hit markers like every 20 years or so, yeah, it's going to, have a much bigger impact, especially when you're in a mania, when you're in a bubble and people have assumed best case expectations and also expecting very rapid and sudden increase in wealth. None of this confirms this. So going back to, my general point here, which is that we have an enormous bubble or bubbles going on. Semiconductor stocks, enormous mania bubble. Tech in general has a bubble because they're the ones most associated with AI. Semiconductors are seen as the biggest beneficiaries of AI, and people have bid these up. In the indices, which is the S&P 500, the NASDAQ 100, I mean, these are concentrated bets on tech and AI. I showed you that the S&P 500 is 23% in semiconductors. Essentially two stocks represent 15%. Top 10 was about 40. Top 20 is 50. Very concentrated, mostly a very large bet on tech, AI, and as a result, they're all in a bubble. So I laid out, hey, what pricks these bubbles, which is rising oil prices, driving rising inflation. And we're seeing that in the PPI, which is the producer price index, which is the prices that companies charge each other. That's going to drive into the CPI, which is the consumer price index, I'll say in like 3 to 6 months. So soon you're going to hear, like the headlines, say inflation rising, inflation skyrocketing. And rising inflation drives long-term rates. We can see it immediately right now in the 30-year bond, starting to make 20-year highs. The 10-year will follow, which has meaningful, direct, tangible impact on mortgage rates, on corporate bonds, on municipal bonds, on pension insurance, on stock market valuations. So my view is that the the big sort of like needles for these bubbles are all like pretty clear. How long will it take? I don't really know. I don't think it's early in this bubble. Maybe there's on the short side a few weeks left. Maybe on the long side there's a few months left. I've been telling Mampilly research members that it's okay to leave money on the table. Stock prices are not permanent. They will not sit there. They will also not just keep going. It's inevitable that these kinds of markets end, and when there's always greater pain than what anybody imagined. So, how does this play out, right? In the short term. Well, in the short term, there's two choices, right? We could have a sudden crash like 2008 style, where in 2008 the S&P 500 fell like over 50%. We could also see a repeat of what we had in 2022, 2023. We had a bear market where some stocks were okay, but other stocks just got crushed. I mean, destroyed 70, 80%. Like many of them were the biggest winners of the market, let's say between 2016 to about 2021. All of those, meme stocks and, innovation stocks that people were very focused on. I mean, those got crushed. And yeah, they came back a little bit this year, but most of them didn't come back. They're down 70, 80%. And even, you go and look today, many of those growth darlings like Lululemon and, and Chewy and others, they're down 50, 60, 70%. So it's possible I mean, we could have a scenario where semiconductors get hit, tech gets hit, and where others don't get hit as much, right? And my view is that that's the most likely scenario rather than a 2008 style, like, everything, crash. Now, it doesn't mean that, the other stuff doesn't get hit, it just gets hit less. But the most important thing is that into a recovery, the things that people want for the new bull market, which won't be in AI mania stocks, will be in something else. Those will recover and make new highs. What's the shape of all of this going to look like? Well, if I were to bet, I bet it looks something like the 1970s. The reason I say this is that market patterns don't like just repeat. So many people might expect a 2008 style crash. In my judgment, we're unlikely to see a repeat of the 2008 style just all out smash. It's more likely that we go through something we really haven't seen for nearly like almost 50 years, which is a stagflation, inflation style market where the big indices like the S&P 500, like the Nasdaq 100, they stagnate over time, but certain sectors do pretty well. And if I go back and look during that period of time, it's scarcity sectors that benefited from inflation. Those are the ones that did well. So here's a chart, for example, of the S&P 500, gold, and I put ExxonMobil because for whatever reason my chart wouldn't bring up oil. But ExxonMobil is a pretty good proxy for oil. So you'll see that the dotted line is the S&P 500. And essentially you begin 1968 is that where you start at what about at about 85. It's the right index here, about 89. And come the end of this chart ends in 1981. Yeah, you're like marginally higher. If you started here at 108, essentially you went nowhere. And you might think, well, hey, that's not so bad. My money's flat. But in between, there were one bear market. This was a pretty big bear market of like negative 50%. Another mini bear market. And the worst part is that inflation was rising through this entire period, anywhere from 5, 10, at the high 15%. You were actively losing your money in real terms, right, after inflation. So standing still over 10 years meant that you actually lost a lot of money, right? And what did well during this period? Well, gold did well, and gold mining stocks did well. Oil did well, and there was an energy crisis during this period. And interestingly, Japanese stocks also did very, very well. And it's interesting today that if you go and look, we're sort of in the same position, which is that scarcity assets like gold, they look good. Oil and energy, they look good. Japan looks good. And I'll throw in one more, which is an asset class that did not exist back then, which is crypto. It didn't exist in the 1960s, but this is another scarcity asset play. We think this is an area that will do as well. So bottom line to, I guess, this whole video, we're setting up for a difficult period of time. I would tell you to be careful, cautious, thoughtful. It's a time to reduce your risk, raise some capital, keep money on the side because yes, cash is losing value, but it's losing value very slowly relative to stock prices. That when people panic, they'll take any price. I mean, what are the prices today? Could be 20% lower tomorrow, 30% lower tomorrow, 50% lower tomorrow. So cash definitely helps dampen the volatility in your portfolio. What about these sectors? I mean, will gold, will oil, will Japan, will crypto escape? No, they won't. When people panic, they tend to panic wholesale and they'll sell everything. It's kind of like somebody yelling fire, in a theater. Everybody runs for the exit. Nobody checks to see if the fire is, if it's near them or not. Right? Everybody runs, and that's how it is with markets. People panic first, ask questions second. However, these sectors that are that benefit from inflation and have that scarcity element to them, I believe they'll fall less than the mania stocks, in semis and tech, etc. And then the big thing is that they will recover and go to new highs. So that's my view of where things stand. Many people disagree with this point of view. Many people think that I shouldn't think this. Many people think that I shouldn't really even say this, that it's bad for the market. Listen, now, I come from a time when, people, you expressed your views because you had a certain idea. And people, if you don't like it, you can obviously turn off YouTube. You can also let it go through one year and out the other. But if you take it seriously, I've been through pretty much every major crash bear market over the last 30 years or so. So yeah, maybe I'm too dumb, too old-fashioned to appreciate all the new thinking behind AI. But I've seen a bubble or two in my time. And this one looks, pretty much like the others. There's a lot of people that have very high expectations for what is going to unfold. And so in this video, I want to come out and make a video just laying out, this is what I see, this is what I think, this is where it's going. And if you are interested in seeing more, reading more, knowing what we're invested in, well, check into mampillyresearch.com. With that, I want to say thank you for watching. This is Paul saying